Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Uh, Happy Thanksgiving. Start with that. Today we're going to go through Twitter, see what people are talking about, what people are sharing on social media. It's going to be financial topics, wealth building topics, and or commodity related, because that's where I think the value is in the markets. So we'll dive right in. I'll give you my financial opinions, and let's get to it. Again, if you want to follow me, it's at finding_finance. If you want to join our community, we do have a discount going on, finding-value.com. The discount code is Turkey if you'd like to join, or if you want to go from a monthly membership to an annual membership, look at the description link below for those discounts. So Figure It Out Money says the S&P 500 experienced a 10% correction amidst a rising dollar and 10-year yield. Currently, the rally is occurring alongside a falling dollar and a decreasing 10-year yield. At present, each of these assets is becoming very tight. If the dollar and the 10-year yield break to the upside, history suggests that the S&P 500 may take a break from this current rally. We chart both of these on the daily technical analysis updates. The 10-year yield is squeezing, as is the 30-year yield. So the long end of the curve is squeezing, and the short end looks like it's just moving sideways. The dollar is also squeezing to some degree, where we could break to the upside on the dollar and the 10-year yield. He's also got the S&P 500 potentially squeezing to the upside. There's a lot of indications that the S&P 500 could be putting in a double top or putting in that bull trap that we're seeing. So let me squeeze that down just a little bit. So that's what we're seeing in the short term here. Get ready. It's going to get interesting. Now, if yields go up, generally you'll see oil go up with it. Now, it doesn't mean it will respond immediately, but they're generally correlated. So we've seen a pullback in oil with yields coming back. We've seen the S&P 500 go up. We've seen gold and silver kind of move up as well. And that may reverse in the short term here if we do get a break to the upside in yields, the 10-year yield specifically. Being a bear gets you nowhere. That comment is absolute blasphemy on FinTwit, I realize. However, going back to 1945, the S&P 500 is positive 78% of all years, with an average annual return of 12% positive. Optimism pays in this game. And if you're playing a long-term game, 5-10 years, I think you have to take an optimistic mindset on whatever assets you have in your portfolio. If the next 5 or 10 years is going to be very inflationary, I'm loading up my portfolio with inflationary assets, assets that do well under inflation. And I have to be optimistic about those assets. You can't be pessimistic and think you're going to have this largest end of the world crash and try to hold through that type of mindset. It just doesn't get you anywhere. Platinum's down 1.5% and palladium's down 4%. Both have been good precursors for gold and silver, which currently are hanging in well despite much better than expected job loss claims and higher inflation expectations. Gold probably washes out below 1900 before breaking out, is what he thinks. Now, when jobless claims go up, or when unemployment goes up, put it that way. When unemployment goes up, I think platinum, palladium, gold, and silver will all go up. I think the markets are getting tighter and tighter from supply-demand imbalances in the metals markets. I think inflation will remain high, and I think a stagflationary environment is highly likely. And I'll show you why I think that with some of these other charts below. So the name of the game here is you want to look for potential big long-term patterns that are falling, like falling wedges, basing patterns, double bottoms, inverted head and shoulders. that are making these big patterns on multi-year bottoms. Accumulate the bottoms and then wait for 5 to 10 years. That's kind of my strategy. I think the market conditions are all aligned for an inflationary push. We're seeing evidence across the board in many, many things where we are similar to inflationary decades. And the commodity to stock ratio and all these different ratios are also suggesting that is going to be the case. So if that's the case, I'm going to load up in those things and wait for the next 5 to 10 years. And I think all of these metals here are way underpriced, undervalued, and underowned. Nobody owns them. So all that money is going to rotate back into this stuff. It's going to be a financial asset to hard asset rotation over time. Mark says, "Welcome to the jungle. We once were flirting with VE rates. Now we have VE equity risk premiums. The equity risk premium is now minus 150 basis points for the Mag 7." And I want to talk about something here. In US equity risk premium on the top here. So every time this has gone upwards, right? This is a commodity bull market, commodity bull market, commodity bull market, commodity bull market. You get what I'm seeing here? Commodity bull market. And what do we have here? Draw a trend line across this. You have a squeezing wedge into a corner here in your US equity risk premium of long-term view. What do you think this is going to do if we were to look at this? In my opinion, we're going to break to the upside and go ballistically to the upside when we break out of this squeeze of US equity risk premium. So I think that this is exactly the same as the commodity bull markets like we've seen before. 1970 it had this, 2000 to 2008 had this, and we're going to get the same type of big move, except this time we are breaking out of a wedge. It's squeezing into this corner that we're going to break to the upside. And I'm seeing this in a bunch of different charts. Big time moves, I think, are coming in commodities, especially from where we are from a valuation standpoint. It says, "I'm upgrading this hyper-crowded super bubble conflated as the market to the most dangerous bull trap of our lifetimes, now in the glue-sniffing stage. If I'm wrong, my detractors will say I'm always wrong. If I'm right, my detractors will be wiped off the map. Semiconductors ETF on the weekly, is this a double top?" I tend to believe it is. And I think this money's going to rotate out of it, and it's going to flow into commodities and precious metals. Both of those have been very good under inflationary time. So this is commodities. You can see the divergence here with this coming on down. But I do think that this is going to head lower. This is also the Batman pattern. Here's the Batman. You can put the eyes here, and this is going to come all the way back down to some level down here. Coming down, uranium sector scrambling to fill current supply gap, which is 28% below present production capacity, and set to worsen as countries turn to clean energy. Experts predict $100 plus per pound inbound. Well, yeah, I mean, that's kind of what we all think. Now, I know a lot of people said, oh, I'm going to sell my equities at $100 a pound. What if we get to $100 a pound and the equities don't move nearly as much as what people think? What if $100 per pound isn't that much money in terms of real adjusted, inflation-adjusted terms? Now, I've got some inflation-adjusted pricing below, and we'll share that number. I think we're going way above $100 a pound, way above. So there's my prediction there, guys. No matter how much you make, you will always feel that you need to make the next jump to feel happy. Makes you think. So how much does your annual salary need to be for you to feel happy and less stressed? So here's the salary bracket, and this is the median salary needed. So they think that they need this. And you can see the gaps here of each amount. And it looks like this one, you can kind of tell about the 100 to 149 that what's needed isn't necessarily, I mean, it's like within the range. Same with this, and then here it looks like if you're over 200,000, you really need to make a bunch of money. Now, I've been in every single one of these here, and I would say how much money is needed. It depends on your costs. The way that I feel is I feel good saving a certain amount of money every single month. That's where I get my happiness from. It's like having enough where you don't have to worry or stress about money at all. And I think this level down here is probably too high, at least for me and a family of five. But I think somewhere in this range in here is probably a good amount to be making between 100 and 200,000. That's definitely, I think, enough. Where you can balance the books, you've got enough leeway with a family of five. Now, if it was just me and I was single, it's probably down here somewhere, like 75, 90. Yeah, that'd probably be a good spot, definitely. I don't think you need to be up here. But obviously, people are spending far more money and trying to find happiness by accumulating junk. um, the key to making, or the key to a happy life, I would say, is just to have really low expectations. Be happy with the basic day to day things. Be happy when the sun's out. Be happy when you've got a nice 60, 70-degree day that is just beautiful. That's all it takes for me. I don't need extravagant things because I just don't really care about those things. So households remain overweight equities versus cash in bonds than during the tech bubble, the 70s and the 2007. They also sit historically underweight bonds and cash, but so would I'm underweight bonds and cash because I think bonds have sold off massively in cash. I'm just not a fan of cash at the time. So U.S. households allocation percent of total financial assets as of 2023 quarter two. So bonds are really low, cash is really low, and they're all pushed over in equities. That's where the bubble's at, guys. That's where the bubble's at. Cash is going to get hit because the bond market's going to get hit. When the bond market gets hit and interest rates go up, the government will try to save the bond market. Then they'll put the pressure on the dollar, but it'll also put pressure on equities as interest rates rise. That's where a rotation of money is going to come into commodities and precious metals. It's because people are going to want to preserve their purchasing power. They're going to have to go to hard assets. It's not going to be an option. They're not going to be like, well, I'll put it in equities. No, they're going to be forced. They will be forced through the interest rates, forcing the S&P 500 down. There's going to be a scare in the S&P 500 or some of these NASDAQ high growth stocks. They're going to see losses in their account and they are going to be forced. Now, this isn't going to be overnight. It's going to take time. And that is going to it's going to create a FOMO into commodities and precious metals eventually. Now, could there be a slowdown in the market before that occurs? Yes, we could get a slowdown in the markets before that occurs. We could see a sell-off in the S&P 500. We could see a slowdown in the overall economy and markets, and that could impact commodities over the next year, maybe, because we do have an inverted yield curve, and that could uninvert. It doesn't mean it has to, though. It could stay inverted, and we could still get increasing rates, and we could still get high rates of inflation, and the curve could stay inverted for a long time. That is where I think people are making predictions, but they don't know the future, and I don't know the future either. So that's what we're going to watch, but it's more of an event that's going to test your patience and time. Because if we get a pullback, it's just one big buying opportunity because inflation's still there, the homes haven't been built, and et cetera, et cetera. Silver is right now squeezed in between a huge support and resistance plus riding the moving average 50. Needs to make a directional choice here very soon. Are you watching this historical inflection point? Yeah, we're breaking to the upside, guys. We have an inverted yield curve. When that curve uninverts, silver is going to hit it. Same with gold, same with platinum, same with silver. It's going to hit it. It's going to hit it in a huge way. Now, you can hedge your portfolio with precious metals against your inflation sensitive assets. So if we do get a slowdown and you get I'm just going to make up a portfolio here, right? Let's say you're 30% energy, 30% other commodities, and 30% precious metals. I'm just making this up, and it's roughly, 100%, 33, 33, 33. If one of them 10 bags and you get losses in your other two sectors, it doesn't matter. Your portfolio is massively higher. Gold and silver work very well under a uninversion of a yield curve. If the yield curve stays inverted, the inflation protected assets could also moon for you. It's not about making money on 100% of the assets in your account. I mean, obviously, that's what the goal is. We're striving to have that goal, but that's probably not what's going to happen in reality. But all you need is a couple of sectors that are basically opposite of each other. You take very large asymmetric bets, which we have in precious metals. We have that in other commodity sectors as well. And as long as they move kind of opposite of each other, the size of the symmetry is going to carry the portfolio higher, even under different market conditions, as long as you know which assets perform well under certain market conditions. So we've got these squeezing in silver. We've got which looks like to me bottoming patterns in platinum and palladium. And we've got gold sitting at almost all-time highs on top of support, on top of massive patterns. Silver also has a massive pattern as well. It's the biggest cup and handle I've ever seen. So if we've got these asymmetric bets where we've got massive upside potential, very small downside risk, well, why don't we just load up in a bunch of these that work under different market conditions, and the symmetry is going to carry our portfolios higher. So that's basically my strategy. And some of my money in these investments may not work in the short term, but they're going to protect me in the longer term as these things move opposite of each other. So I know a lot of people, what they try to do is they try to time everything. They try to time and put all their money in one sector. It may work for you, and concentration can make you rich very quickly, but it can also hurt you very quickly as well. Trying to concentrate and time things can be very difficult. When I hear classic contrarian investing saying like buy low, sell high, be a contrarian, buy when there's blood in the streets, be greedy when others are fearful, I think about this silver chart, the setup of dreams. Getting in before the general public is always key. This is a double bottom. It says at this top, silver was $50. My price target for silver at the end of this bull is $370, says Grady. Could go double that if silver goes ballistic at the end of the bull market. And what he's using is he's using silver divided by the S&P 500. It obviously depends on where the S&P 500 is, because that's probably going to go down to some degree. But remember, under inflationary periods, it may not go down nominally is what most people think. It will go down in real terms against silver, gold, and other assets. And that's where the prediction of the price gets really difficult to do. But this is a double bottom. We're at the bottom of the double bottom. And I'll be honest, guys, I bought the crap out of this. I bought the crap out of this bottom. There's other bottoms that are out there as well that are just ludicrous in terms of pricing. And all I need to do is buy at the bottom. And I know some people ask me, how long am I willing to wait for some of these investments? I'm willing to wait 10, 20 years. And they're going to be like, well, that's an opportunity loss. No, it's not, guys. If you look at all this and you look at the conditions, the upside is so massive that I have to have some money in it. I won't be able to sleep at night knowing how much upside potential rewards there are, how little downside risk there is. The absolute difference between the upside potential and downside risk for the risk reward is something I have to do if I know about it. Silver, gold, platinum, palladium now is pretty low. These upside potentials are so big and the risks are so little if you play them in the physical metal that I just shake my head at it. I'm like, this is just a matter of time now. I think it's going to happen way less than a decade, for sure. It's probably going to happen in the next few years that these things start to rip it. But everyone's going to react off the price. They're going to say, hey, look at that shiny object that just went by. They're going to say, hey, look at the price movement in silver. I'm going to go buy it now that it's at $100 an ounce. It's going to come, guys. And they're going to do it out of the fact that they have to do it to preserve their wealth. When the S&P 500 goes down, when bonds continue to be under pressure, people are going to have to go to those sectors. That's where the money rotation will occur. And we've seen it in history every single time. And what it occurs when people have to make a change, when they're losing nominal dollars or they see that those other assets are vastly outperforming their assets. It just takes time. Uranium, very good point. It says adjusted for the M2 money supply, uranium is priced at $27 a pound. Oh, we're going to peak out at $27 a pound, inflation adjusted. No, we're not, guys. We're going way higher. 86% of Republicans say their cost of living has gotten worse since 2020 per bank rate. How could anyone, irrespective if you're Republican or Democrat, say that their cost of living has gotten better since 2020? I mean, I don't know why they would say Republicans, but my cost of living has skyrocketed since 2020. In fact, I think it is so different that when I look backwards, I think that that world feels and looks different than the world that I've experienced after 2020. I think that something's changed dramatically. My costs are mainly food, and my food bills have skyrocketed. I would say they're up at least 3x. At least. Now, I know I've got 3 kids, and they're obviously eating a lot more. So it's a combination of having to buy more food and a combination of the price moving higher. But I would say my bills have gone up in terms of food at least 3x. Global oil exploration capital expenditures have been insufficient for nearly a decade. The lower and more volatile oil prices remain, the higher they will go for longer. The bill will come due. Totally agree. As we estimate required spend to meet demand is $600 billion higher versus the prevailing outlook. And look at the spending here, guys. Look going forward, how much CapEx is needed to meet demand. It is way up there. Now, you know I'm an energy bull. We know that energy is going to go higher. Now, if we are going to spend all this money to meet the demand in the future, and let's just say you're an energy bull, who's going to get all this money? My guess, energy service companies are going to crush it. These are the things that people need to look at. Now, every time I look at a chart, I remember all this piece of information. I just say, you know what? I'm going to put that in the bank. If CapEx needs to go vastly higher, we're talking many, many multiples higher than we've ever seen in history to solve our demand out in the future. I should bank that. I should say, you know what? I should probably go buy a bunch of energy service companies. And what if there's some energy service companies where they're struggling today, but if this is coming in the future, who's going to benefit the most from this? Who's going to make the most amount of money? Who's the most leverage to this potential move? I've got a whole bunch of companies in my portfolio that are massively leveraged to this outcome here. And you know what? I think this outcome has to come with time. It may not occur in the next year, but I think it will occur sometime between now and 2030. That is the strategy, that's the paradigm that I have and the outlook that I have on the markets. So I fill the portfolio with these potential setups that are out there. This is SPUT. This is what I see, not perfect, but it is interesting. I don't believe we've reached 0.8 yet. Correct. This is a Livermore accumulation cylinder. And guess what? It's occurring in a whole bunch of different sectors, not just uranium. It's occurring in the home builders. It's occurring in some of the financial banks. It's all over the place. This is going to be a big bull market, guys. Big, big, big. Millennials help to accelerate home price growth, in my opinion. In the 5-year window from 11 to 2016, there were 8.6 million first-time home buyers. In the 5-year window from 2017 to 2022, there were 12.6 million first-time home buyers. And it's getting greater and greater as household formations are outpacing housing builds or housing starts. So it's going to be a big, big bull market, guys. So twice now in less than a week, we've seen an overnight sell-off in WTI with almost a complete recovery during the daytime trading. This, to me, looks like a bottom, guys. It really does. Anyone want to convince me that this trade isn't massively manipulated? I don't know if it's manipulated, but whenever you get these big sell-offs in the morning and it gets bought way back up, that's generally a bottoming type formation. So I think it's trying to bottom. This was one of the best models I've seen for assessing the health of the labor markets. 7 different indicators. 6 of them currently flashing warning signals. So we could get a slowdown here. I agree. And this is employment-based recession composite. The only thing that gets me, though, is unemployment can go up for a period of time, but there are still a gaggle of job openings. So I think we're just going to see a massive shift in the economy from certain sectors to other sectors, and I think that has to occur. There's going to be friction in the markets as this rotation occurs. It's going to go from financial asset companies, tech companies, into oil and gas and hard asset companies. But we could have a recession in the beginning of this great rotation. Inflation is highest in Miami. I thought that was interesting. I live similar to Denver, just south of Denver, so it looks like I'm in a high inflation area. Just thought that was interesting. Gold and commodities index diverged in 2008, great financial crisis. Then the CRB dropped into 2020 lows, which I called. It was clear back then that a new commodities bull market has started. And with the enormous divergence back then, it was clear the moves were going to be massive. Have been and will be. So we've got a big move between gold and the CRB index, and that's going to close that gap. Now, that gap will close, in my opinion, with gold moving higher and the CRB index moving up as well. Oil is a global commodity, and such investors need to track global inventory levels, not just those in one region, which releases dubious data on a weekly basis. And look how low we are in 2023, guys. Global oil inventories everywhere has declined, and we're at the lowest levels that we've been. Why is the price of oil so low? Good question. And I would exploit that opportunity. Even though oil inventories can be low, if people think a recession is coming, that could also impact the oil price in terms of financial positioning. So we'll see how this plays out, but I'm long oil. It is inflation sensitive, and it would get hit in a recession, but that's also why I hedge myself with a big precious metals portfolio as well. So that's where I'm going to end it, guys. That's what we've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. If you're a member, we've got a 7 a.m. question and answer session coming up on Saturday. You can ask me questions, interact with me directly, and we go over a lot of potential setups in individual companies. If you like a lot of the stuff that that I've got here. Definitely subscribe to the YouTube channel as well. All right, guys, we'll catch you later. This is Finding Value.